Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Tony Roth, Chief Investment Officer, Wilmington Trust, to discuss how much the Fed will need to raise and the likelihood, duration, and steepness of a recession in 2023. Tony, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me, Jill.
All right, you got it. And this market and economy has been laser focused on what's happening with macro. What's the principal risk to the economy right now?
The principal risk is going to be the Fed not being patient enough. It does take a while for not only the Fed's activities and tightening of the monetary environment, but also the overall organic slowing of the economy. It takes a while for those factors to really flow through to inflation. And if the Fed is impatient and moves too quickly, then we'll have a worse recession than we otherwise would. And so a recession is not really, if we have a recession, it's really probably how bad is the recession going to be. And right now we think it's probably going to be a mild recession, but if the Fed is impatient and raises too much, too quickly, it could be a worse recession.
Yeah, it seems as if the markets are more impatient than the Fed is. And of course, that applies pressure to their policy strategy. So how much do you think the Fed needs to raise? And what are your thoughts about the likelihood, duration, steepness of a recession in 2023 if it stays its course?
Yeah, so I think the Fed probably needs to raise to around 5 to 5.25%, and then needs to hold there until we see what I think the key fulcrum for the economy is right now is labor demand. That's really the thing to think about, because when we think about services inflation, it's about wage inflation, and wage inflation in turn is a function of labor demand. The Fed can't affect labor supply at all, just like for most types of things that trade in the economy. The Fed can't really affect supply for most things, certainly not labor, but it can affect demand. And so we need to see demand come down so that the balance in leverage between the employer and the worker reaches a more traditional equilibrium, if you will. And then you'll start to see wage growth come down significantly. And once we start to see that, then the Fed will probably start to lower rates, because at that point we'll be in a recession.
Right. So where do you see inflation going in 2023, and what other factors outside of Fed policy are really impacting it?
I think inflation is probably going to come down to around 3%, which is not the Fed target of 2%. And that's one of the questions that really underlies this ultimate query on how patient the Fed is going to be. Will the Fed recognize that there are some really important structural forces that may prevent inflation from coming down to 2%, even with a recession? And specifically, what I'm thinking of is essentially the loss of workers in the labor force. The participation rate has really dropped, and that has caused this balance between supply and demand and labor to fundamentally change. That's one thing that's happened. We have a big change with China, where China had always been an unlimited supply of cheap labor. That's changed, not just due to COVID, but due to President Xi and the way that China is trying to avoid the so-called middle income trap and trying to really move up the continuum in the quality of economy that it runs, from a manufacturing-based economy to more of a service-based economy. And then lastly, there's this energy transition. And the energy transition is one where we're clearly seeing a lack of energy because the green base is not ready yet, and the hydrocarbons are so unpopular that we're not seeing the capex in order to create the hydrocarbons we need in the meantime. And so when you put all those together, notwithstanding an aggressive Fed, we're probably not going to get down to 2%. The Fed might have to live with a higher inflation rate for a number of years. And if they're okay with that and loosen the monetary environment, we can move back into a growth cycle. But we don't know how the Fed is going to react to that reality.
What does the earnings story look like for the all-important Q4 earnings season and for the year? Do you see an earnings recession? That seems to be like the last shoe to drop to get that capitulation moment in the market, if you will. It doesn't feel as if it's rebased yet.
Yeah, well, so I don't think that it's baked in yet. I think that the reason is that the market is looking through the recession and it's looking to the other side later next year, where it thinks the Fed is going to aggressively lower rates, because this particular Fed has been very focused on the third rail, which is to say the economy, economic activity, GDP, and not singularly focused on its dual mandate of inflation and the labor market. And so, having said that, if you have a recession, you are necessarily, almost by definition, going to have an earnings recession. We've never had an economic recession without an earnings recession. So we do think an earnings recession is coming. And we probably see for the year next year, earnings coming down to low 200 range, somewhere between 205 and 215. That's not priced into the market in our view right now. And so we wouldn't be surprised to see this market make new lows relative to the June lows that were set. We're not calling for that per se, but it wouldn't surprise us if that happens.
So Tony, where are you overweight and underweight with this backdrop?
We're overweight cash, we're underweight risky assets. So we've moved to an underweight on equities, as we do think that this needs to get priced into the market. And we think the recession, frankly, is global. So it's not just US equities, but it's also non-US developed EFI, emerging market. It's really all equities. And we're overweight cash because we don't like bonds right now either, particularly given the slowing we expect will result in turn, widening of credit spreads for both investment grade and high yield bonds. And given the structurally higher rate environment that we're describing, that's going to last for some number of years, we think the 10-year is trading at too low a risk premium. The term premium that's embedded in the bond is not high enough. And so the 10-year, which is currently trading at 360, should be somewhere in 4.25 to 430, 440, somewhere in that range right now. And so the increase in rates and the widening of credit spreads together will also cause bonds to depreciate. So everyone talks about the bad year for 60-40. I think most of the pain is behind us, but there's still some pain to come where we could see high correlation of stocks and bonds trade down together.
All right, Tony, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
My pleasure.